Think we're ready to get started here on this Facebook Live. So I'm going to go ahead and welcome everybody. Grateful for you joining us today, where we're talking everything about this question of foreclosure crisis coming up in 2021. So I know we have a lot of people that have so they're going to be on this, and so I want to give it a couple of minutes and just let those of you that are getting on join it. I'm going to try to follow along here on the side here and watch comments. Our team is going to be answering, questions and comments and filtering those back through to me as we do this Facebook Live. So please put your comments and questions in. As always, let us know where you're watching from today. We're excited to have so many people on and talk about this big question that I think is being talked about in YouTube and social media, and a lot of people saying, okay, hey, what's going to happen next year? How can we sustain the momentum that we've had in the real estate business? And so we're going to answer all of that. We're going to use a lot of data, a lot of facts, kind of quell the emotion of what people are saying and give you the answers so that you can respond. So those of you that are joining, we're excited to have you on here. And I'll even ask a question. I think a lot of this foreclosure question kind of, originates with, high unemployment. We're going to talk about that, forbearance, things like that. Do you know the number of mortgages that are in forbearance right now? If you're a KCM member, you're well prepared for that. You probably know that, but I'll ask you that. Maybe in the comments, tell us, do you know the number of mortgages that are in forbearance, either as a straight number or as a percentage? And we'll go through this and we'll check and see if you were right. So let us know that. Let us know where you're watching from, and we're going to get started here. I know we have a lot of KCM members, a lot of you that have just said, hey, I want to be a part of this. I want to get the information and the facts. Our team has prepared a lot of information on this subject so that you can be the knowledge broker. That is our goal today, is to give you the information, to be the knowledge broker. And I think there is certainly a way to do that. We're going to talk about that probably for the next 45 minutes or so. This will remain on Facebook like a live always does, so you can go back to it if you want to reference it. If you're a KCM member, all of these slides are going to be in the KCM member area for you to access. And here's what I would ask you to do right now. Tag a couple of people that you know and say, this is what we've talked about. This is a conversation that you and I were having, because a lot of people are talking about this, and tag somebody that needs to hear this so that we can get those folks involved in the conversation as well. So as we get started, let's go ahead. And I see Mark, you just said 2.5 million. We're going to come back to that. Good to see everybody on there. Again, I asked the question, do you know how many loans currently are in forbearance as a percentage or either as a number? And I'm going to answer that in just a little bit. We'll see who's there. So Nicholas, I see your answer there. Glad to have everybody on right now. I know we have more people joining, but let's go ahead and let's bring up the slides. And I want to start with a quote from Showing Time today, because I think it will set up what we're talking about relative to this this question. And Showing Time came out and said, market data has always been a powerful tool for real estate, but 2020 marked a new high point for how data was leveraged to encourage informed decisions and to help real estate professionals reinforce their status as market experts. And that's what we're talking about today, reinforcing your status as the market expert. They go on to say, while interpreting data can seem overwhelming, the industry jumped at the opportunity to take advantage of new market data tools to get a true appreciation for how their markets were responding to the pandemic and to reduce client fears about its effect on their buying and selling goals. So using local information, using the national information that we're going to talk about here is what we do at Keeping Current Matters. We look at macro US data. You're going to want to have that, but you're also going to bring in your local information. So let me do something real quick, because I think it's going to set up how we're going to talk about the day. I want to kind of rewind and go back to where we were in April, using data from the experts. And if I go back to April, we were talking about how experts, major financial institutions, are calling for this V-shaped recovery. And there was a lot of people saying, well, I don't know if it's going to be a V, it's going to be a check mark, it's going to be another shape, it's going to be this, it's going to be that. And we said, okay, look, in the first quarter, we took this little dip down, a big dip, and then we're going to come right back. Let's look real quick at what experts said and then what actually happened. And I think it'll give you this picture that looking at what experts are saying, and they're not always going to be right. I'm not saying that, but what we can do is say, this is what experts are saying. I'm going to give you the best information. And here, what actually happened is literally a mirror of what the experts said. Now, again, it's not always going to be the case, but position yourself to say, this is what experts are saying right now. And as that ever changes, I'm going to be the source of the information. A lot of this conversation starts with, unemployment and the questions around that. The Federal Reserve Bank just came out and made a statement on unemployment, and they said, in the next quote here, that data from the Survey of Business Uncertainty suggests that the road forward is going to be a tough slog. Businesses hold tepid expectations for a year ahead of employment and sales growth, and expectations are, in fact, so tepid that based on the latest average projections, it'll take more than 4.5 years to recover to pre-COVID employment levels, there in that quote from the Federal Reserve Bank. So if we look at that, we look at the quote from the Federal Reserve Bank, we can kind of say, okay, they're saying that 4.5 years to return to pre-employment levels, exactly what we've been saying and what experts have been saying through this. So if you're a KCM member and you got out there with this information and you're delivering this, you were able to come ahead of the market and say, okay, this is what projections are. If we go back to that May 2020 look at that unemployment chart, and I'm going to bring this updated chart back into what we're doing to give you that perspective. And it looks a lot different today, but it gives you that confidence to go out and carry this message to the clients that you serve. So to do that is what we're going to spend the next, 40 minutes, 45 minutes or so on, and grateful to have every one of you on here. I see so many people joining right now. Again, tag somebody that needs to hear this message and say, hey, this is what we've been talking about. This is something that we need. And so, our team has worked hard. And I want to give you a resource here. I know maybe not everybody can stay on the whole time, but our team has built a resource, how to succeed in a changing real estate market. Because like we started off talking about, data and insights are what make the difference in an uncertain world, right? In times of uncertainty, be the voice of reason. That's what we've said throughout this pandemic. And I think when we look at that and we go back to that original Showing Time quote, that's what's made the difference in so many people's businesses in being able to help families and individuals through this. So if you want to go grab that, it's at trykcm.com/succeed. A great resource for you to really kind of adopt the mindset of what does it take to succeed in this changing market. So I'm excited to get this kicked off. I know we have a lot of people on. I'm watching people join still right now. And I want to kind of pose 4 questions around, will there be a foreclosure crisis in 2020? And my goal today is that you get off of this, once you've watched it, you're well equipped to answer this question. And I'm going to break it down across 4 areas that our KCM research team has done an amazing amount of work, brilliant people, to go out and find all these facts and figures so that you can be the knowledge broker in your market. So first question, what is a foreclosure crisis and what are experts saying? This term of crisis can be in some aspects a relative term, right? What is a crisis? So we're going to define a crisis and give you a way visually to show people what a crisis is and where we're at today. Second, we're going to talk about what's happening right now in the economy, in unemployment, and in forbearance, because those are the things, those are the external forces bearing down on this question that we need to understand to be able to go out and answer. Third, we're going to look at forbearance and what's happening to those individuals as they come off of forbearance. We've got a lot of good data there that will help in explaining to people what is going on, in quelling the fear of what's going to happen. And then fourth, we're going to cover the question, what is different now than in past scenarios, and give you some really good information to be able to do that so that you can go out confidently and answer these questions. And my only request of you in all of this is, again, if you're a KCM member, all the slides are going to be in the member area. You can go grab those, but don't let this information die with you today. Use it in in videos that you record and social media posts that you put out there, and any information that you're delivering, because this is the message we need to get out. If you go to the KCM blog today, you can see a blog on this topic that you can immediately share to get that message out. So let's kind of hop in and let's look at this with the first quote here from Bankrate. It says the COVID-19 pandemic will lead to a rise in mortgage defaults and foreclosures. But as the housing market muscles through this economic downturn, it looks as if foreclosures will form a trickle rather than a flood, housing experts say. No, right now where we stand, there's a moratorium on foreclosures in this country. And so when that moratorium is listed, no doubt foreclosures are going to go up. Here they call it a trickle rather than a flood. So we'll talk about what that looks like. And I think the first thing we need to do is, again, go back to that question. What is, he calls it here, a flood. I'm going to refer to it as the crisis because that's how it's often, termed in social media and on YouTube and different places about, okay, what is a crisis? So let's go and look at the chart of foreclosure, numbers by quarter going all the way back to 1999. So that's what this is a picture of. You probably, if you're a KCM member, have seen this before, but we've changed it just a little bit and updated it so that red area you see in the middle, I'm going to call that a foreclosure crisis. That was the housing crisis in 2008. And you see there the high point of the second quarter of 2009, over 500,000 foreclosure filings in that quarter. Many quarters before that and after that, very, very high, approaching that number. And, as we look at this crisis, that's what we want to go back and say, okay, that is a crisis. We had a housing crisis back then. And as we kind of look to the right to where we are now, you see that number with the dotted line, 206,000. That's an important number that I want you to remember. 206,000. If you go all the way back to 1999, that is the average number of foreclosures per quarter in this country for the last 20 years. And where do we stand today? The second quarter of 2020, there were 23,900 foreclosure proceedings in the second quarter. Now that number is incredibly low. It's even lower than where we've been over the last several years. And that is because there has been a moratorium on foreclosure. When that is lifted, those numbers are going to go up. Now, if you took that number of second quarter foreclosure filings and you multiplied it by 8.5 times, you'd be up to the average. Now, I'm certainly not suggesting that is what's going to happen, but I'm saying to put things into perspective, when you hear something say, hey, foreclosures are going to double, foreclosures are going to triple, it depends on what number they're basing that off of. But if you use these numbers, they wouldn't even get to the average of where we've been in the last 20 years. So important to remember just about where we've been. I want to go to the next quote here from Aspen Grove Solutions, because I think they give us some perspective as we look forward. They say, unlike 2008, strategic defaults have not emerged as a serious problem and seem unlikely to emerge. Now, strategic defaults, it's not something we've been talking about in the last 10 years. That was the strategic step away from a mortgage. We owe more on it than it's worth. And the best thing for us is to walk, not even a question or concern in today's market. They say, given strong expectation for property price increases, a record low inventory of homes, and stable residential underwriting standards leading up to the crisis, which has reduced the number of owners who are underwater. So let's think about that for a second. They're saying, hey, strategic default's not a problem. Property prices are projected to increase, low inventory, and underwriting standards. We're going to talk about each one of those pieces because I believe this conversation originates back in the housing crisis. And you've seen this slide here of the months of inventory, homes for sale and the difference between a buyer's and a seller's market. Back in 2008 and 2010, we literally had an oversupply of homes on the market. And again, supply and demand going to always dictate prices, and prices fell. We saw prices fall sharper than we've ever seen in this country in housing. And where do we know we are today? Very, very different place relative to inventory being at historical lows, and that keeping upward pressure on prices going forward. And so I think it's important to, even though you've maybe seen that slide or you're familiar with it, you've seen that graphic, the people that you're talking to aren't as familiar with it. They're not in our business. They don't do this every day and they don't understand that. But if we look at projections, we go back and we say, okay, Aspen Grove Solutions said the forecast is for prices to appreciate. We can go look at what experts are saying about the projections for price appreciation. And you see 7 right here. If we take out the outliers of CoreLogic and Zillow on either end, the majority saying between 3 and 5% next year in a very, very good market. So certainly that checks out. And we see low supply, and we see incredible demand driven this entire year by low interest rates and falling interest rates. 12 times this year, the average 30-year fix has fallen to a new low. Think about that. 12 times. And that has driven consumers to say, I need something different in my home. I need something, that is going to meet my family's needs, my needs, and what I have. The other question that they bring up in the Aspen Grove Solutions quote we just read was lending standards. Now, if you've been following KCM, we use the Mortgage Credit Availability Index, and certainly lending standards have gotten stricter since the housing crisis. But what we have in the next slide is a look from the Urban Institute of product risk and borrower risk, really default risk in the mortgage market going all the way back to 1999. But the visual of this is very impactful. Now, if you look at any mortgage product or any risk in the credit markets, they're going to have a little bit of consumer or what we call borrower risk, and they're going to have some risk in the product. The tolerances of who they let use that product or borrow money that way, based on the standards of credit score, down payment, all those types of things. Now, you see on the left, that'd be reasonable lending standards where there's a portion that's product risk, there's a portion that's borrow risk, and that's how money is made in that business. Well, you advance to today, product risk has been eliminated. I mean, think about that. The products that were available back then aren't even available in the market today, and borrower risk has been severely dropped. And that meaning, standards have gotten tougher for people to qualify for a mortgage, and all the products, all the things that were done back before the housing crash aren't being done today. And so, when you look at that, you go, okay, that checks out as well. Things are different in the market today. And so as we kind of frame up this conversation about what are experts saying? Experts are saying, hey, it looks a lot different. Now I'm going to continue on this road about this, but I want to say one thing real quick. I've mentioned a couple of times that all of these slides are in the KCM member area. If you're not a KCM member, I want to encourage you to start a free trial today. You can go to trykcm.com and start a free trial if you're not a member, because whether you're a member of KCM or not, you need these insights in the market. You may be getting them somewhere else and able to deliver this, but we want you to become a KCM member. Our team has built a lot of resources. I'm going to ask that they put those links in the comments here, that you can go to keepingcurrentmatters.com/resources and see videos, see a blog post, a lot of information that'll help you in this conversation. But more than anything, I want you to start a free 14-day trial of Keeping Current Matters, because this is information you need to get out into the market. So as we continue on this journey, I want to go to the second question: what's happening right now, and really what's happening in the economy with unemployment and forbearance. So all through the pandemic, we've been, whether it's been on a deep dive or This Week in Housing or something else, we've talked about, okay, here's what's happening in the economy with unemployment, with forbearance. And so I want to give you a snapshot of that so you can see this is what's going on. These are the external factors I mentioned that are bearing down upon us that cause a lot of these questions, right? Is the economy recovering? So if we continue on with that, let's look at consumer spending across the country by state. And what we can see here, this is a map of the US and consumer spending as compared to January 1st. So where are we at relative to where we were in January 1st? And let me draw out a couple of examples there. You look at Arizona, they are 1.5% above in consumer spending where they were January 1st. And let's take a contrasting look at Texas is 5.1% below where they were on January 1st. So what we want to see is we want to see that consumer spending return. And the majority of the country is in this brownish mustardish color that is within 10% of where they were January 1st. Now, a lot of economies, if it's dominated by the travel business or dominated by something that's been heavily impacted in the pandemic, taking longer to recover. If there's not, if there's less of that business, maybe not taking as long. And so you get a picture of that. But I think you can go out and say, look, hey, consumer spending is returning. Now, as we've looked at this year, a lot of that driven by the stimulus that's coming in. Or I mean, the stimulus that we've had this year. And then the question is there another one coming? And I think there is a big question mark on that. We don't have a crystal ball to be able to say that right now, but it's safe to say consumer spending is returning across the country. The other question is unemployment. Let's look at that from the Bureau of Labor Statistics around the unemployment rate. And the story here is that, the unemployment rate went up dramatically in April, and those that were, whether temporarily or permanently, out of work based on the lockdown. And that's come down each month since then to where the most recent unemployment report, 6.9% unemployment in this country. Now, I'm not suggesting that is a good or a low unemployment number. It's a number that we want to see come down even further. And if one person doesn't have a job, we want them to have a job, but it's certainly not 14.7%. And visually, if you look at where we started in February at 3.5% unemployment, it gives you perspective to say, okay, we're at 6.9% unemployment in this country. Unemployment coming down. Now, we started off with a quote that says it's going to take 4.5 years to get back to where we were. So likely to start to, drop slower as we go on down the rate. But if we start to compare this to the Great Recession and Great Depression, that slide that I showed you before after the experts, you see it looks nothing like the Great Recession or the Great Depression, which dominated headlines just a couple of months ago. But this updated look really gives you that impactful way to communicate that if somebody's asking that, what's going on with unemployment? I've heard it was worse than it was in the Great Recession or the Great Depression. To be able to dispense this information. Now, I want to say something in this information. Crisis or unemployment and all those things are certainly relative topics. If my family's affected by that, that's a crisis for me. And so I think we want to handle that in a sensitive way and say, okay, how can we serve you through this? How can we help as professionals in our business through this? And certainly using this information with care is our job. But I think all of this leads up to this question of forbearance and what's going on with forbearance. Now there's the concerns of forbearance and there's the reality of it. Now, when we started this, there was a lot of talk about forbearance, how, up to 30% is what industry people were saying was going to go into forbearance. Okay. And they basically said, all these people are going to go into forbearance and every one of them is going to end up in a foreclosure. Well, that's not exactly how it's coming down. Not anything like it. We're going to give you the data behind that. So these initial forecasts of 30% never happened. The actual peak was 8.6% of mortgages. And the question I ask on the front end, currently there are 5.67% of mortgages that are in forbearance, down from that peak of 8.6. If we look at the next slide, you can see that the numbers of mortgages that are in active forbearance has been dropping and quite dramatically. This most recent week here, 2.74 million mortgages in forbearance. Now, I saw somebody in the comments there say 2.7. I can't remember who that was, but if you were one of those people, you got it right. If you were one of the ones that said 5.6% of mortgages in forbearance, you got it right. But having some of those numbers at your fingertips are going to help you have these conversations. Now, 2.75 million mortgages, a lot of mortgages in forbearance, but again, not where it was. And we want to see those people come off. And we're going to talk about that in just a second. So is that leads us into this third question. What is happening to the individuals as they come off of forbearance, right? Because those numbers in themselves have don't answer this question completely. We want to be able to answer that. And on the topic of questions, I'm going to ask you this. Our team is watching on the comments, and I'm going to try to monitor this as well. If you have questions, put them in there. I'll try to watch that. I don't know how good of a job I'll do on that, but ask those questions. We'll get them. If we don't get them right away, we'll get the answer back to you. Try our best to do that, but our team will also funnel those in to us. So let's talk about what's happening to those individuals right now. So if we look at that, this next graph shows us of the families that were granted forbearance, about 5.7 million of them. This is what happened upon the plan expiring. So the first, if we start from left to right, we look at that dark brown orangish bar. 2.397 million mortgages in forbearance extended upon the expiration of that. So we've talked a lot about this at Keeping Current Matters. I'll go over it real quick. The CFPB allows for extension. So initial forbearance was 180 days. There was the ability to extend for another 180 days for a total of 360 days. Now the question is, once those people come off, what's going to happen there? So let's kind of put that off to the side. We'll answer that in just a minute. The next two bars, the blue and the green bar, 2.3 million removed while they were performing. They continued to make their payment. Those were people that said, you know what, I'm going to take forbearance today because I don't know what tomorrow holds, but I'm going to continue to make my payment and have it as an insurance policy just in case. 500,000 mortgages were either paid off through a sale or the mortgage was paid off during that. That's 44% of those that went into forbearance either came out making their payment or paid off their mortgage. Nothing happened to them, almost half. Think about that. 481,000, that gray bar there, they expired and are in some form of loss mitigation. Think about that as that's a workout with the bank. When we started this, we talked about 2008, the housing crisis, how the banks don't want these homes back if they can work something out. I believe they're gonna try their best to do that. It's not going to be the case in everyone, but certainly, banks saying, hey, look, we're going to tack this onto the end, or some form of workout for those that are coming through it. And then that last bar, 80,000 people expired while delinquent. Now, going back to the comment before that all these people are going to go into forbearance and they're going to end up in foreclosure, is just simply not happening. Those are the ones, the 80,000, that last bar on the right, those are the ones right now that I would say are, candidates to go into foreclosure. And those are the ones that, are the ones that we want to watch and say what's happening. But it certainly, as a percentage, is not the overwhelming majority of these mortgages. So that's the thing that I think you want to pay attention to. We're going to stay on top of it. That first number is about 40,000. It's grown up to about 80 right now. I'm going to go to a couple questions. I know they've been asked. What are the options banks are giving for repayment? That is a very tough question to answer because it's going to vary from bank to bank to bank. The biggest misconception about forbearance is that you would go 3 months behind and then on 90 days later, you'd owe all those payments. And the cure rate, meaning the ability for someone to make those payments once they're 90 days late, traditionally in our business is very, very low, because if you couldn't make one payment, how are you going to make 3 payments? So we know right now banks are not doing that. If somebody had the financial ability to do that, they certainly could. But most are saying, hey, we'll let you tack it on the end. We'll let you pay a little bit of a portion, as you go along to make up these payments. There's a number of different things happening. And I would even ask people to weigh in on the comments here. Maybe some of you have seen people that have come out of it and gone through a workout. Add that in, to the chat, and maybe there's some things out there that you're seeing that you could add to it. Will there be a replay on this? Great question. This will remain on Facebook. If you're a KCM member, all these slides are in the member area. We've done numerous deep dives on it. If you go to Keeping Current Matters /resource, I did a 5-minute video on it. There's a blog post on there on the 3 graphs that prove there's not a foreclosure crisis in play. And so you're going to want to go check that out, keepingcurrentmatters.com/resource. They'll put that in the comments. How many in California? I don't know the answer to that, broken down by state. So I think that's one that we want to look at. Uh, why are we still experiencing such low inventory, and what will eventually change this? Great question. I think right now the reality of low inventory, which is certainly keeping these upward pressure on prices, even though we've had a great year in real estate this year, there are a lot of families, a lot of individuals that have not put their homes on the market due to a couple of different concerns. One, I don't know where I'm going to go. And two, I may not feel safe to do that. The health concern, the COVID concern. As we start to make a change in seeing more good information coming out, and I don't have a crystal ball to be able to say this is what's going to happen exactly, but I think we can start to expect to see better information come out. Now we've got the winter to go through, and big concerns coming up here with cases spiking and all of that. I'm not diminishing that, but what did we see a couple of weeks ago, or whenever that was, that the first vaccine announcement came out saying, hey, it's effective. We saw one come out yesterday saying, hey, this is going to be even more effective than the first one. And now the market is looking for, okay, what's the next bit of good information coming out? The reason I can tell you that I think that's what we're going to see is we're starting to see the mortgage market shift as well. Now, you never know the bottom until it's in the rearview mirror. Okay. But I think we could be in a place right now that's in the bottom, which is a little bit off subject, but I want to address that and get through that. But I think it's a great question. Inventory will come back as people feel safer, and I think it's our job to say this is how we can sell your home safely. And as people say, this is where we're going to go. Builder confidence is at an all-time high, and builders are bringing inventory back to market. So, good information, good question. Let's go to that next question. It shows the reality of this, and then we'll move on to the last question here. It comes from the MBA, from Mike Fratantoni. Nearly 2/3 of borrowers who exited forbearance remained current on their payment, repaid their forborne payments, or moved into a payment deferral plan. All of these borrowers have been able to resume or continue their pre-pandemic monthly payments. So the forbearance question is not playing out the way that originally, folks would have thought, or what people said, which is very important to remember. So let's go to this next question, and again, I'll start to look at questions here and keep asking those as you have them. Our team will answer those for you. I'll try to answer as many as we can going forward. So what's different now? This is really where the question, I think we can answer it. And I'm going to give you some things, maybe some reminders and some new information, relative to the market, and really give you a way to show you, there's not an impending foreclosure crisis coming. And so if we start out here, I want to start with a quote from Bill McBride from Calculated Risk. He says, "This is very different from the increase in delinquencies following housing standards. Lending standards have been fairly solid. We covered that earlier. You saw the Urban Institute graph, and you've seen the Mortgage Credit Availability Index. We know that." And he goes on to say, over the last decade, and most of these homeowners have equity in their homes, and they'll be able to restructure their loans once and if they are employed. Now, what's the story here? What's the difference maker today versus in the housing crash? It's equity. By far, I can't say it enough times. There were lessons learned in the housing crash that people do not want to repeat, and they've handled equity differently in their homes. Now, if we look at home equity cashed out back then, we can see there was a significant amount of equity cashed out in homes. You see that in the red bars. And in that, people were, using their homes to literally fund their lifestyles, going on vacations, buying jet skis, doing whatever they wanted to do, thinking this will never end. And where we see today is considerably below that, not even the same. Now, the question always comes up, well, what were the equity percentages back then? There's not good information on that, I can tell you, but we can use this information to say, let's go back to that slide there real quick. We can use this information to say, okay, people are handling equity differently, and they learned lessons in the housing crash. They said, we don't want to repeat. Now, your question would logically be, well, that's starting to tick up right there, and you're absolutely right. Even the last bar is only the first, second, third quarter of this year. And you can see that this year will end up higher. Now, my response to that is, yeah, you're seeing it tick back up, and people are using equity to get through this financial crisis caused by the pandemic. And good for them. Good for folks that have that tappable equity and they can use their homes to do that. But people are treating equity very, very different than how they have in the past. We go to that next slide that you just put up. Again, I'm going to remind you that 58.7% of the homes in this country have at least 60% equity, and the average home, CoreLogic tells us, has $177,000 of equity inside of it. So again, tremendous, tremendous equity. Why does this matter? The next quote from First American sums it up, and it's this: with enough equity, a homeowner has the option of selling the home or tapping into their equity through a refinance to help weather the economic shock. Why is this important right now? People have options. Think about it logically. You own a home, you're going through a tough time. Why would you let that home go into foreclosure and not sell it, put some money in your pocket, and get to the other side of this crisis versus foreclosure? And again, I want to talk about this in a way. We're saying, without a doubt, and I'm going to reinforce this at the end. There's about zero chance we have a foreclosure crisis in this country, but that doesn't mean we don't need to talk about it as professionals. I think we need to be talking about it. We need to be out there, because I don't know that it's like somebody's going to come knock on our door and say, I'm having trouble making our payments. Some may do it, but it's certainly something that is a very, very personal situation. I think our message, whether you share today's blog from the KCM blog, you go on some of those resources and get some of the information, share that information, make a video, put something out on social media to say, if you are having a challenge right now, let's sit down and talk. You can direct them back to their bank. You can say, okay, what's the equity you have in your home? Just what is your arsenal of tools that you can help someone with right now that may be going through this? And I think that's our job. I think it's our obligation right now as professionals. So if we continue on this, I want to talk about this equity question inside of those in forbearance. The next slide shows active forbearances by current loan to value. And the punchline here is right below that title. It says 91% have at least 11% equity. So 91% of the homes in active forbearance today have at least 11% equity. So they have options. That's what I'm trying to say. Now, if we look at the other side of this, that means that 9% of the homes don't have that. And the reason equity is so critical, again, is they can pay a commission and put a little money in their pocket and move on down the road. If you bump that 9% up to a round number of 10%, you could say, okay, there are 2.75 million mortgages in forbearance right now. 10% of that's 275,000. And I'm certainly not saying all of those mortgages are going to go into foreclosure, but if they did, that'd bring 275,000 homes to market. Now, let's go and look at where we were at inventory September of last year. There were 1.6 million homes on the market, and we were in an undersupply scenario. Today in 2020, there were 1.2 million homes across the country on the market. If you added that 275, we wouldn't even be where we were last year when we were still undersupplied across the country. So I'm not saying 275,000 homes are going to come to market, but what I'm saying is people have options. This is not 2008 all over again, where people were underwater. They had to do things. They can go out and sell the home. And oh, by the way, we don't want to see that happen to anybody, but we know it happens as a fact in our business 206,000 times on average for the last 20 years each quarter. And our job right now is to be able to try to go out and help those folks and help them with what they have going on. So as you look at that, you look at all this data, you can go back, you can go in the KCM member area, grab the slides. Here's what I'd say, and it came off a podcast from Ivy Zellman that Tom Ferry did. And she says the likelihood of us having a foreclosure crisis again is about 0%. And I think when you look at this, you look at the data, you go, yeah, that makes a lot of sense. But the truth is, people out there today don't have access to this information. It's our job to get it out and to get it in the hands of people that have these questions. So let me go through and look at some of the questions that have been asked. How will the equity in homes be affected by this COVID-19 crisis? I think there's strong equity across the country. Hopefully, people that have equity that are affected by the crisis are able to use that equity to weather the storm. And we're seeing that. Cash out refinances suggest that that's happening. It doesn't suggest that they're using it improperly or that it's shooting back up to housing crisis levels. So I think we can be encouraged by that. But there's still time to go on this year, and certainly questions to be answered there. Are there any stats on forbearance, urban versus suburban? There really aren't that I know of. These are larger stats that are out there, relative to the totality of the market, not delineated by geography or something there. Do you expect the trends to change for people still in forbearance than what we see now? People still in the program may have weaker credit, may have shifted to more delinquency. People out of the program may have had stronger credit. So what they're saying there is, okay, the people that got out earlier were probably stronger than the people that are in there now. I think that's a fair analysis of it. What we know, though, is that the people in forbearance have a strong credit or a strong equity profile in the home. So I think as we look at that, we look at rising prices. That's why I would be having conversations with people to say, do you know the equity you have in your home? We've talked a lot about doing a pair, a preferred equity assessment report, and going in and saying, do you know with rising home prices, there's a lot of talk in the media about rising home prices. Do you know the equity in your home? If we can see, okay, what do you owe on your mortgage? Here's, traditional CMA. Here's the equity you have in your home. What do you want to do with that? For a lot of people that are in forbearance right now, that gives them the option to, okay, maybe you need to liquidate your house. Maybe you need to do something like that, put it on the market before it, were to go into foreclosure. And so I think that's the question. Do you have a sense, I'm gonna read the next question. Do you have a sense of how many borrowers opted for immediate default as opposed to forbearance? I don't have a sense of that. There are foreclosures happening that are in, non-owner occupied. The moratorium is on, people are in it. Now, I think that as we go through the moratorium being lifted, that's the question that's going to be posed. But again, I would expect that you're going to see in the media, your customers are going to see foreclosures are on the rise. Certainly they're going to be on the rise. We understand that, but not at crisis proportions. I think I've answered most of these that we've had. Can you bring the slide back up on how to succeed in a changing market? So I want to offer that to those of you that maybe weren't on the front end of this. Our team has built a resource for you titled "How to Succeed in a Changing Real Estate Market," and no doubt right now that has that is the name of what we're in, is a changing market. I started out this with a quote from Showing Time that basically said market data has been a powerful tool in real estate this year, really changing the way agents are communicating data. In times of uncertainty, you want to be the voice of reason. So this is a resource for you that you can go to trykcm.com, trykcm.com/succeed, and really see the mindset of what you need to be doing to instill confidence in your clients. So with that, I'm going to wrap things up. If you're not a KCM member, as always, we would love to have you as a KCM member. We are grateful for the time you invest in attending these Facebook Lives or webinars, things like that. We don't take it for granted. And just a huge shout out to the entire team at Keeping Current Matters that works every day to build these insights, build all these visuals so that you have the information you need to be the voice of reason with the people you serve. So grateful for your time today. Thank you for joining. and we'll see you soon.